In a world grappling with economic uncertainties and geopolitical tensions, today's top stories reveal the profound shifts shaping our future. From evolving cryptocurrency regulations to significant geopolitical maneuvers, the landscape is changing rapidly. Here are today's top 10 stories you need to know. The cryptocurrency market is experiencing notable pressure, with Bitcoin trading around the low $60,000 range. This decline stems from a broader risk-off sentiment fueled by ongoing geopolitical uncertainties, including tensions in Eastern Europe and inflationary fears. Analysts suggest that this market behavior reflects heightened investor apprehension as traditional markets also face volatility. Additionally, several crypto stocks, including firms like Bitmine and Solana Company, have seen significant sell-offs, further indicating a bearish trend. The overall trading activity in the crypto market has softened considerably, with many altcoins underperforming. As the market adjusts, many are questioning whether a recovery is imminent. Looking ahead, the market's direction will heavily depend on macroeconomic indicators, particularly inflation rates and central bank policies, which could either stabilize or further destabilize investor confidence. In a significant regulatory move, the UK's Financial Conduct Authority has conducted raids on multiple locations in London. These actions are part of an investigation into suspected illegal peer-to-peer cryptocurrency trading activities, which have raised alarms about consumer protection and market integrity. The FCA's crackdown reflects a growing concern over the regulation of digital currencies in an evolving financial landscape, as cryptocurrencies have surged in popularity and complexity. Regulators worldwide are grappling with how to effectively oversee these transactions while preventing fraud and money laundering. The implications of these raids are profound, potentially leading to stricter regulations on crypto trading in the UK and influencing policies in other countries. This development underscores the urgent need for clarity in the regulatory framework governing cryptocurrencies. As scrutiny intensifies, businesses and investors may face significant operational changes in the near future. Canada is taking significant steps to regulate stablecoins as part of its broader strategy to oversee cryptocurrency markets. This initiative comes amid growing concerns about financial stability and consumer protection in the rapidly evolving digital currency landscape. The discussion centers on establishing comprehensive guidelines for stablecoin issuers, particularly focusing on their reserves and backing requirements to ensure they maintain sufficient liquidity. While some experts argue that the immediate impact of these regulations may be limited, the move highlights a proactive approach by Canadian authorities in a global context where many countries are crafting similar frameworks. As the stablecoin market continues to expand, a robust regulatory environment is crucial to mitigate risks associated with potential market volatility. With these regulations, Canada aims to foster a safer environment for both issuers and users, ultimately promoting trust in digital assets. The outcome of these discussions will likely set a precedent for future cryptocurrency regulations in the region. In the United States, the introduction of the Genius Act marks a significant step in establishing a federal framework for stablecoins. This legislation aims to set clear rules for stablecoin issuers, including necessary reserve and backing requirements. The rise of stablecoins has transformed the cryptocurrency landscape, offering a bridge between digital currencies and traditional finance. Their increasing adoption raises concerns about regulatory oversight, particularly regarding consumer protection and financial stability. By implementing defined standards, the Genius Act seeks to mitigate risks associated with these digital assets. This initiative is crucial for fostering innovation while ensuring adequate safeguards for investors. As Congress deliberates on the Genius Act, stakeholders, including financial institutions and tech companies, are closely monitoring its progress. The outcome could influence future regulatory approaches not only in the US, but also globally. If successful, the Genius Act may serve as a model for other nations grappling with similar challenges in the rapidly evolving cryptocurrency market. The cryptocurrency industry is witnessing a significant expansion in institutional infrastructure, highlighted by the development of a new collateral framework. Leading financial institutions, including Standard Chartered, BlackRock, and OKX, are collaborating on this innovative framework for a tokenized treasury fund. This initiative is designed to enhance the integration of digital assets into traditional financial systems, addressing a growing demand from investors for reliable and secure options. As institutional interest in cryptocurrencies continues to rise, such partnerships represent a pivotal shift towards mainstream acceptance and utilization of digital currencies. The establishment of robust infrastructure is essential for supporting the evolving needs of investors, ensuring transaction security, and fostering regulatory compliance. This expansion not only bolsters confidence in the cryptocurrency market, but also encourages other financial entities to explore similar ventures. Looking ahead, the successful implementation of this collateral framework could catalyze a wave of institutional investment, potentially reshaping the landscape of global finance and paving the way for broader adoption of digital assets. In a significant enforcement action, Europol has successfully seized the Cryptomixer service, which was allegedly involved in laundering cryptocurrencies. This operation highlights the increasing scrutiny on digital currency services, particularly those that obscure transaction origins. Cryptomixers have gained notoriety for facilitating illegal activities by allowing users to anonymize their cryptocurrency transactions. As governments and regulatory bodies ramp up their efforts to combat financial crime, this seizure reflects a broader commitment to establishing a transparent and secure financial ecosystem. The ramifications of such actions could lead to stricter regulations for cryptocurrency services worldwide, potentially reshaping how these platforms operate. Users may face higher compliance costs and increased scrutiny of their transactions. For operators, the future looks precarious as they navigate a tightening regulatory landscape. Law enforcement agencies are likely to continue targeting similar services, making it essential for the industry to adapt swiftly. As the cryptocurrency sector evolves, stakeholders must prioritize compliance to mitigate risks and foster trust in the digital economy. The ongoing transformation could redefine the role of anonymity in cryptocurrency transactions. Despite the current market pressures, Bitcoin continues to maintain its dominance in the cryptocurrency space. Recent data indicates that Bitcoin's market dominance is hovering between 56% and 58%. This dominance is significant as it often serves as a barometer for overall market sentiment, influencing investment decisions across the board. While altcoins have struggled with volatility and regulatory scrutiny, Bitcoin's resilience underscores its status as a leading asset and a store of value. Analysts note that Bitcoin's established infrastructure and widespread adoption contribute to its stability, setting it apart from other cryptocurrencies. Furthermore, recent developments, such as institutional investments and increased interest from retail investors, have bolstered confidence in Bitcoin's future. The ongoing evolution of blockchain technology and decentralized finance may also play a critical role in shaping market dynamics. As the landscape evolves, Bitcoin's role remains pivotal in shaping investor confidence and market direction. Looking ahead, experts suggest that a sustained recovery in the crypto market will likely depend on renewed demand for Bitcoin, along with favorable regulatory developments and technological advancements. Recent reports indicate a significant decline in overall trading activity within the cryptocurrency market. Combined spot and derivatives volumes fell to $4.41 trillion in May, marking the lowest point since September 2024. This downturn is attributed to a variety of factors, including ongoing macroeconomic pressures such as inflation and interest rate hikes, which have dampened investor sentiment. Additionally, a notable reduction in interest for altcoins has contributed to dwindling trading volumes. This decline raises serious concerns about market liquidity and overall health, as lower trading activity can lead to increased volatility and uncertainty. Analysts are closely monitoring these trends, seeking potential recovery signs as they assess the implications for investors and traders. The cryptocurrency sector faces the challenge of reigniting interest and demand, which may require innovative developments or regulatory clarity to restore confidence. Furthermore, as institutional investors reassess their strategies, the market could see a shift in dynamics. Looking ahead, the ability of the cryptocurrency market to adapt and introduce new offerings will be critical in determining its resilience and potential for recovery in the coming months. A recent analysis has revealed that 74 out of the top 85 non-stablecoin assets have posted negative monthly returns, indicating a significant weakness in the altcoin market. This downturn reflects a broader trend as investors increasingly shift their focus towards safer assets amidst ongoing market volatility caused by macroeconomic uncertainties. The Federal Reserve's interest rate hikes and regulatory scrutiny have contributed to this risk aversion, prompting traders to gravitate toward Bitcoin and other more established cryptocurrencies. As altcoins struggle, the impact on investor sentiment becomes increasingly pronounced, leading to heightened skepticism regarding the viability of many smaller projects. This environment suggests that a recovery in altcoins may be challenging without a broader positive shift in the overall market. The decline of altcoins may also lead to increased consolidation within the sector as weaker projects face mounting pressure. Analysts predict that unless Bitcoin stabilizes or rallies, altcoins could continue to suffer. Furthermore, the current landscape raises questions about the long-term sustainability of many altcoins, which may struggle to regain investor confidence. As traders navigate these turbulent waters, the focus will likely remain on Bitcoin's performance, which could serve as a crucial indicator for potential altcoin recovery in the coming months. Recent regulatory developments are reshaping the cryptocurrency landscape across major jurisdictions. In the United States, the Genius Act aims to establish the first federal framework for stablecoins, which are digital currencies pegged to traditional assets. This bill seeks to enhance consumer protection while fostering innovation within the sector. Concurrently, the Clarity Act proposes shifting oversight of digital assets from the Securities and Exchange Commission to the Commodity Futures Trading Commission, signaling a significant shift in regulatory philosophy. These legislative efforts reflect a growing recognition of the need for clear regulations in the crypto space, as both lawmakers and market participants grapple with the complexities of this rapidly evolving industry. In the European Union, similar discussions are underway, focusing on creating a cohesive regulatory environment for digital assets to ensure investor protection and market integrity. The UK's Financial Conduct Authority's recent raids on non-compliant firms underscore the urgency and seriousness with which regulators are approaching this dynamic market. As these regulations take shape, they could significantly impact how cryptocurrencies are traded and utilized, potentially fostering greater institutional investment. Investors and industry participants are closely monitoring these changes as they navigate a rapidly evolving regulatory environment. Looking ahead, the success of these frameworks will likely determine whether innovation thrives alongside necessary protections, shaping the future of cryptocurrency for years to come. Thank you for watching today's News Roundup. Which story shocked you the most? Don't forget to like and subscribe for more updates.